Credit cards are a powerful financial tool, but they can quickly become a major burden if you do not understand how interest is calculated. Lenders advertise their interest rates as an annual percentage rate, or APR, which makes the cost of borrowing sound simple. However, the way interest actually accrues is far more complex than just applying a yearly percentage to your balance. Many people believe they only pay interest if they make their payments late, or that interest is calculated once a year. These misunderstandings can lead to unexpected charges and growing balances. In this video, we will explain the mechanics of credit card interest in plain English. We will break down how your daily balance is calculated, explain the concept of the grace period, and walk through a detailed mathematical example of how interest is added to your account. To understand credit card interest, you must first understand the annual percentage rate, or APR. Although interest is expressed as an annual rate, credit card companies do not calculate interest on a yearly basis. Instead, they calculate it daily. To find your daily interest rate, you must divide your APR by 365. For example, if your credit card has an APR of 24%, your daily periodic rate is approximately 0.0657%. Every day, the credit card issuer applies this daily rate to your outstanding balance. This daily calculation means that your interest compounds, which means you pay interest on your interest. To determine the balance that the interest is applied to, issuers typically use the average daily balance method. The issuer takes the balance at the end of each day in your billing cycle, adds them all together, and divides by the number of days in the billing cycle. For example, if your balance was $1,000 for 15 days and $2,000 for the remaining 15 days of a 30-day cycle, your average daily balance would be $1,500. The daily rate is then applied to this average daily balance and multiplied by the number of days in the billing cycle to calculate your interest charge for that month. This daily calculation method is why carrying a high balance, even for a few days, can lead to a significant interest charge at the end of the month. Additionally, understand that credit card compounding occurs daily. When interest is added to your balance, the next day's interest is calculated based on that new, higher figure. This compounding effect is why credit card debt can spiral out of control so quickly if only minimum payments are made. The minimum payment often barely covers the daily interest that has accumulated during the month, leaving the principal balance virtually unchanged. By understanding that interest is a daily cost, you can see why paying down your balance as soon as possible, rather than waiting for the monthly statement due date, saves you money. The most important defense against credit card interest is the grace period. The grace period is the window of time between the end of your billing cycle and your payment due date. By law, this period must be at least 21 days. During this time, the credit card company does not charge interest on new purchases, provided you paid your previous statement balance in full by the due date. This is a critical detail. If you pay your statement balance in full every single month, you maintain your grace period, and you will not pay a single penny of interest on your purchases. However, if you fail to pay the statement balance in full, even if you pay 99% of it, you lose your grace period. When you lose the grace period, interest begins to accrue on your existing balance immediately. Furthermore, interest begins to accrue on all new purchases the very day you make them. This is known as the interest trap. Once the grace period is lost, it does not return automatically when you pay off the next bill. To regain your grace period, you typically must pay your statement balance in full for 2 consecutive billing cycles. Understanding this mechanism shows why paying your card in full is much more important than simply making the minimum payment on time. For example, if you have a statement balance of $500 and you pay $490 by the due date, you have carried a $10 balance. You will be charged interest on that $10 balance. But more importantly, because you did not pay the full $500, you have forfeited your grace period. This means that all your purchases during the next month will accumulate interest from the minute you swipe the card, even if you pay the new bill in full on time. The cost of carrying that tiny $10 balance is far higher than the interest on the $10 itself. To protect yourself from interest charges, you must understand your monthly statement. Your statement contains three critical numbers: your total balance, your statement balance, and your minimum payment. The minimum payment is the lowest amount you can pay to avoid late fees and maintain a positive report on your payment history. However, paying only the minimum will not protect you from interest. To avoid interest, you must pay the statement balance in full. Let us look at a simple comparison table to clarify the impact of different payment choices on your statement. Payment choice: interest accrual, late fees, grace period. Status: statement balance in full, 0 interest, none, maintained / active. Minimum payment only, high interest on remaining balance, none, lost immediately. Below minimum payment, high interest plus late fees, yes, lost immediately. To implement a safe system, set up auto pay for the statement balance rather than the minimum payment. If your income does not allow you to pay the balance in full, make your payment as early in the cycle as possible. Because interest is calculated on your average daily balance, paying down your balance mid-cycle reduces that average, which directly lowers the interest charge you will face at the end of the month. By managing your card with these rules, you keep the benefits of credit without paying the high costs of interest. Additionally, be aware that cash advances and balance transfers typically do not have a grace period. When you withdraw cash from an ATM using your credit card, interest begins to accrue immediately at a rate that is often higher than the standard purchase APR. Lenders also frequently charge a flat fee for these transactions. To avoid these expensive charges, treat your credit card solely as a tool for standard purchases that you can fund with existing cash in your checking account, rather than a source of short-term loans. This discipline protects your cash flow from unnecessary erosion. The budget mechanic helps everyday people fix the way money moves through their life. We explain budgeting systems, debt payoff methods, saving habits, credit basics, and financial decisions in simple, practical terms. This channel is for education only, no hype, no stock picks, no get-rich promises. This video is general personal finance education, not professional financial, investment, tax, or legal advice. Financial situations vary and details depend on individual circumstances.